Hey, how's everybody doing today? Having a little bit of technical difficulty. Let me see. Hey, how's everybody doing today? Having a little bit of technical difficulty. Let me see. There we go. Hey, how's everybody doing? Dave Van Horn here. Welcome to my Facebook Live. And today's topic is buying properties without banks or money. So before we get into it too much, I wanted to talk briefly about some of the things we covered last time. One of them, which is it was how to acquire real estate and building wealth with unsecured debt. And I know we went into a lot of different things. I told a lot of stories about how I bought properties with credit cards and how we even talked about business lines of credit. We talked about commercial notes. We talked about peer-to-peer. So we talked about a lot of different things on how you can build wealth with unsecured debt. And on a couple of previous live calls, we actually covered finding leverage, and we also talked about debt elimination and the accelerated pay down of debt. So today I'm hoping to talk about buying properties without banks or money. Now this is literally one of my favorite topics, and for those of you who don't know me, I'm Dave Van Horn. I'm author of Real Estate Note Investing. This is a book put out with BiggerPockets, and some of these strategies that I'm going to talk about are actually covered in this book. Especially today, there's a couple areas I'm going to talk about subject to investing a little bit. I'm going to talk about lease options, and I actually cover those in chapters 6 and 7. So if you haven't had a chance to pick up the book, you might want to grab a copy, and you can go to biggerpockets.com/note investing. And I'm also going to be having a special promo code for you guys, which is pretty phenomenal. I can give you a discount code for 20% off if you type in live note investing, all one word, live note investing. You'll get 20% off. So let me see who's joining us today. Some of you guys are coming in from all over the place. So anyhow, hey Tom, what's up? So some of the different things I'm going to be talking about today will be traditional investing, right? So a lot of us start out, we go to the bank, we get a regular loan, and it's great in the beginning. I have nothing against bank financing. I actually like bank financing when I can get it, but I think you always have to play by their rules, and you have to fit into a certain box, and everything has to be just so for you to get financing from them. And then eventually they seem to cut us off, right? We go for so long, and then it kind of comes to an end. And a lot of times they're requiring large down payments. I consider a lot of bank financing risky. Now that's a concept for people at first because they don't understand what I mean. And if I have to put a large down payment down, to me that's a risky investment because I have a lot of money tied up in that deal. And the only reason I can get away with saying that is I'm fairly experienced, and I've bought many properties with little to no money. And that's some of the things I'm going to be talking about today. So there's a lot of situations where I didn't put much capital into the investment at all. And it's pretty cool when you're able to do that. So, what I like about that is it's a game changer, right? If you can invest with very little capital out of pocket, it's literally game changing. Hey, Alex, what's happening? Nikki from Baltimore. Merlin from Millersburg. Where's Millersburg? Sounds like a town in western Pennsylvania or something. Daniela from Bucks County. That's actually near me, not too far from me. So great to see you guys on the call. Welcome to everybody. Like I said earlier, today's topic is buying properties without banks or money, which is definitely one of my favorite topics because if you can do it without spending any of your own money, it's pretty powerful, right? So I was first talking about this traditional bank financing and some of the the drawbacks to it. In the beginning, most banks will give you 4 loans or they'll give you up to 10 loans. At one time, believe it or not, they would give you much more than that years ago. There were times when I was able to get 20 loans in my own name or my wife's name. And today, obviously, it's around 10 as the max. And then you're kind of forced to go into commercial financing. And commercial financing's terms aren't as favorable, right? Hey, Mike from LA. I was just out in LA recently, this past weekend. And Travis from Denver was in Denver in February. Denver in February is, it's still pretty cool. There's a lot of snow, right? You can go skiing. So it's good to see you guys. And Jason from Memphis, welcome to the call. So a lot of good stuff I think we're going to cover tonight. But so I was back to traditional financing, bank financing, and to me it's hard to conceive that a bank financing would be high risk. But in the beginning it isn't, right? So when you first buy your first FHA property or VA property, you're only putting a couple percentage points down. You're able to finance some of your closing costs sometimes. They allow seller assist. They allow gift letters sometimes. So you don't have a lot of skin in the deal. And that's one of the reasons they make you pay private mortgage insurance, or with FHA, it's called MIP, mortgage insurance premium. And the reason they do that is because you're not putting 20% down or more. But let's get back to traditional financing. At some point, the bank's going to start to require more and more down payment from you. So if you go, you might get away with 3% down, then maybe a 5% down, and then maybe a 10% down. But eventually, they might want as much as 20% down or 25% down. And it starts to sting a little more, right? You really need to have a really good deal to be worth tying up that kind of cash, plus your closing cost, right? So requires a lot of money sometimes to buy property from a traditional bank. And sometimes we buy a property, maybe you're in California where prices are high or something, or New York City. And a lot of times we're looking at situations where it's negative cash flow. So not only are you putting a large down payment down, in my eyes, when we do that, we're taking on a lot of risk. And that's a concept. A lot of people don't think of it about being risky. But let's face it, real estate can be risky just like any other investment, right? There's ups and downs in the market. There's up markets, there's down markets. In my area, we just came out of a good 10-year down market, right? So who could predict that? And a lot of people can't weather that type of storm. So you got to be cognizant of the fact that real estate's risky just like any other investment. It has its ups and downs. Sure, we'd like to think it always goes up, but we all know that that's not true. And if you're putting a large down payment down and the property value falls, your money is at risk if you're forced to sell. So you are taking on some risk. And if you're negative cash flowing, we all know what that could mean if things get tight for us. And then also with some of the traditional financing, we get into what I call the landlord trap, especially with buy and hold properties. Now, I'm a guy that's been buying and holding property for 30 years or more. So I have a lot of experience in it. And, I hear a lot of stuff on different websites, BiggerPockets too. And, people are, all gung-ho, especially when they're new to the business. But things can change with the landlord trap, especially if you put 3 kitchens in the same house in 10 years or something. Your outlook could change on some of these things. Or, I have properties I've done full renovations 2 and 3 times on. And a lot of times people don't like to discuss that on the air, right? So, but it does happen. And I'm going to show you some ways to, potentially avoid some of that landlord trap and avoid some of the traditional bank financing and things like that. And I think the way we could do some of that is through note investing and options and things like that. So let me see who we got on there. Eric said he loves the book, Real Estate Note Investing. Hey, I loved writing it too. Now, there's a lot of goodies in there. Who else? Josh from Raleigh, North Carolina. Good old Duke University down there, right? And Dowd from Bloomington, Illinois. Hey, welcome to today's broadcast. So let's get into it a little bit. I know last 2 weeks ago that I did a call with you guys. It was about acquiring real estate and building wealth with unsecured debt. And I tell the story of buying homes with credit cards back in the day when credit card availability was easy. It was easy to get a credit card. It was easy to get cash advances. The fees were low. The rates weren't too bad. It was pretty easy way to access capital to do deals. Now today it's much trickier than that with credit cards, and I really wouldn't recommend that. But I do like the idea of using other people's money. And I know Brandon wrote a great book on that. By all means, get to the BiggerPockets store and pick that up. But there's a lot of great ways to buy property without your money or without the banks, the traditional banks. And, some of the easy ones that come to mind today are, using private money or hard money. It's a great strategy to lock up a deal. And you can do this with buying notes too. A lot of people say, notes are a capital intensive business. And a lot of times folks will say to me, well, how do I get started in the note business? Don't I need a lot of money? And the answer is you need money, but it doesn't necessarily have to be yours. And I know when in the beginning we started our note business, in the beginning a little bit of our own money, but we quickly just saw that the business model worked. And then we went out and started raising money, or we found money in other places, right? We would use our home equity lines of credit. We would use our IRA accounts. We would use friends and family's IRA accounts, and friends and family would lend us money to go buy notes and do deals. So basically they were our JV partners. So you can always find money partners or JV partners if you have a good business model, if you have a good deal. It really comes down to if you have a good deal and you can show someone that you have a good deal, you should have pretty good luck in being able to raise the money to do the deal, right? So I know in buying notes with other people's money, you can do a JV model, like I said. So you don't necessarily have to do. You might have a source for the notes. You might have the ability to work the notes, do a modification maybe, but you can team up with someone else and do the note. It could be their money and you do the work, right? I have a lot of friends that have done that. You can pool money. I have a real good buddy in North Jersey who's done that very well. He would pool together some different investors. They would put their money together. They would go buy a pool of loans, and he would get paid in a broker fee, or he would get paid in notes. So great strategy for him, worked very well. And a lot of times, even if you own notes, you can recapitalize on your notes. So if you have a note and it's performing, you can sell a partial of the note to get your money back, to go back to market, buy another note. Or you can do a collateral assignment, a note and mortgage, where you're borrowing against your note and your note's the collateral for the loan. You get some money again, you go back to market, you buy another note, and you can kind of repeat the process again and start to acquire more and more notes. And a lot of times you can cash flow off a collateral assignment of note and mortgage. So I know we've covered that on some other calls before and in some other articles and in the book too. And then of course there's private equity, right? So private equity is where you're doing a private placement, almost like a syndication would be for commercial real estate. Done plenty of them. When it came time to doing it for notes, it was fairly easy for me because I had done quite a few with commercial real estate. And it's really the similar model, right? You raise private equity to go buy, in this case, pools of mortgages, right? Now, you can also do that to buy properties. You can also do that to set up a syndication to buy tax liens. You could do it to set up a syndication to buy apartments or warehouses or anything, storage centers, you name it, right? So you can syndicate to invest in anything as long as you disclose what it is you're investing in. And there's some great strategies of using other people's money to build wealth. And one of the advantages of private placements is it does two things. It protects the investors because it spells out an orderly liquidation if things were to go awry. And the other piece is it acts like kind of an insurance policy for the fundraiser because everything's disclosed, all the risks are disclosed, that type of thing. So another great way to buy assets without your own capital. So other people's money, as you can tell, I'm a big fan of that. Mr. Pat Heller, no one knows private money and raising capital and hard money more than Mr. Pat Heller out there. Good to see you, buddy. Nikki, nice to see you. All kinds of people. Allison, What's happening? So, welcome to the call. Talking about buying properties without banks or money. I do talk about that a little bit in the book, Real Estate Note Investing, which you can get 20% off today if you use the code Live Note Investing. All one word, Live Note Investing is the coupon code to get 20% off today. Real Estate Note Investing. And you can get that at BiggerPockets.com/note investing. If you like what you're hearing, give me a couple thumbs up, write me a review, all that good stuff, right? Leave me a comment. Love the comments, love the questions. So let me see what else we got going on. So we're talking about other people's money. So buying properties without banks or money, it really comes down to finding the deals, right? It's one thing to, sure, we all need a source of deals. We all need some form of capital. And then obviously we have to work through the deals, right? But I think a lot of the sources of our deals, where do they come from? And for me, they've always come from these motivated sellers. And I know even in the note business, if you really think about, we specialize in buying distressed mortgages. Well, where do they all come from? And they really come from a motivated, well, they're not sellers really. They're more like someone in distress, right? But the distress is usually from death, divorce, job loss, or medical reasons. Well, when you find a motivated seller, a lot of times, it's from that same thing, right? The motivated seller is coming from a tough situation too. And a lot of times it is death, divorce, job loss, and medical. That's why a lot of times people are getting their deals through probate or through bankruptcy court. They're finding these, or through divorce court. They're tracking down lists, that type of thing. But a lot of motivated sellers come from other areas as well, right? They could come from just downsizing or even upsizing for that matter. They need to move, or they're a relocation. They took a job in another area. They had to move out of state. Now they're carrying 2 properties, that type of thing. They could be a tired landlord like me, right? I'm a tired landlord. So there's a lot of ways we can find motivated sellers, even in the MLS. I remember I used to search in the MLS for things like long time periods on days on the market, or someone that was listed with multiple agents over a long period of time, and obviously they haven't sold their home. Or I would look for, estates, or I would look for handymans, or I would look for, what's the other one I used to like a lot? Was administrator, because then it was usually a nursing home situation. And most nursing homes really are just liquidating the property. They don't even necessarily care what it sells for. So that's another great place to get a distressed asset and get a good price from a motivated seller. So, but for me, I know a lot of people do direct mail, bird dogs, which are wholesalers. I used to have some of my best work was done with bird dogs, and I'm going to come back to that a little bit. Mention the MLS. Also for sale or for rent. Now, back when I was doing it, there was newspapers. Today, it's probably Craigslist and some other vehicles. And obviously, I'm in the note business now. But one of the things I used to love to do, I'd be looking for lease options or subject to deals. And I would approach the for sale and for rent ads. So for sale ads, I'd be looking at calling someone who's been on the market for a while, maybe a for sale by owner, and I'd be asking them questions like, if I came by and saw your property today, would you ever consider a long-term rental? Well, if they, I could just call for sale ads all day long, and if somebody said, yeah, I'd consider a long-term rental, well, I'd jump in my car and go look at that, right? So pretty easy potential lease option there. They want to sell, and a lease option is selling it to me down the road, right? Or selling it to one of my hungry tenant buyers, so to speak, and I'm looking for a motivated seller. And the reason they're a motivated seller is they have their house on the market, it's all cleaned up, it's ready to go, but they haven't been able to sell it. Maybe they're asking too much for it, that kind of thing. So when I go to them and say, hey, would you consider a long-term rental, I already know they're willing to sell it, right? So I know they're a perfect lease option candidate if they say that they would consider a long-term rental, and would they consider selling it to me down the road, that type of thing. So that's a for sale ad. If I look at a for rent ad, I could do the same thing, right? I can call the for rent ads, Maybe it's for a for rent ad that's been sitting around for a little bit. Because that might be a tired landlord in the mix there. So I could call the for rent ad and do a similar query, and I would ask the question, hey, if I was a good tenant and I were renting your property for a while, would you ever consider selling the property down the road to me? As soon as they say, yep, yes, they would, I jump in my car and I'm going to look at that property, because I know, again, it's a potential lease option, because I already know they want to rent it. I already know it's ready to rent. So I don't have any work to do, which I'm a lazy guy. And hey, Nikki, what's happening? Good to see you guys from the Chicagoland. So anyhow, no, I love the idea of going out there and locking up a lease option, because I've done many a sandwich lease option, which is where I do a lease option with the seller of the property, and then I turn around and lease option it to a hungry tenant buyer, is what I call them. And my strategy for both is a little bit different. I could talk about that a little bit. So like my terms might be different for when I go out to the seller, for example. And I've even bought some of these properties from people who I've sold property to, which is kind of weird, right? But I used to sell a lot of investment property, and I had guys that I would sell. One time I sold a property to a gentleman who he had it for a little while. He rehabbed the house, he rented it out, and the tenant trashed the place. And he went in and he remodeled it again, and he had it up for rent, and it wasn't renting. And he said to me, he goes, I want to sell the place. So I was going to put the house up on the market for him. I said, look, why don't you sell to me on a rent to own? And what I did was, he knew me. He knew I was good, a good buyer, tenant buyer for him. And what I did was, I did a 5-year lease option with him. I forget now. I think the payment was right around what his payment was per month. It might have been a little extra, but it was no more than $100 more than his mortgage payment, including principal, interest, taxes, and insurance. So he was happy there. And then I turned around, and I had a tenant in another multi-unit I was managing, and that tenant was looking to get a house. I said, you know what? I think I have a house right down the road. And I took this couple over, and they were in one of my apartments that I was managing, and I took them down to this rent to own, and they said, oh, we would love to buy this someday. And I knew they were good tenants because I was already managing these folks. And they actually did a 2-year rent to own, and obviously I was able to get a $3,000 deposit, and I had put a modest deposit on my buddy's place. And it worked out really well. And the guy selling the property, he was responsible for major repairs over like $300. And the new tenant buyer was responsible for anything frivolous under $300. You see where this is going. And oftentimes I'd even put a home warranty on the property, which is a nominal fee. And it keeps me out of the maintenance business, right? Now the tenant buyer could just call the, the home warranty insurance company if there's anything major goes wrong, or that the seller is responsible to fix, or anything frivolous they would fix, because after all, they're going to buy it, right? So these are great strategies to not only make a few grand when I moved the person in, but I was able to cash flow a few hundred a month while the time period was going on, and I had plenty of time to finish that off. Now, probably only about 1 out of 4 actually buy it. So the option there would be to give the property back at the end of 5 years, or to buy it, sell it to someone else. But the other thing I used to do was give them a credit when the tenant buyer was paying their rent. Sometimes I would give them a credit towards the purchase price, but I was locking in the purchase price 5 years in advance, which is pretty neat, right? You can actually get some appreciation on that deal. And sometimes even that payment can knock down some of the principal I owe. So there's a lot of neat ways to structure these types of deals and really create a really good deal. And there's nothing better. I mean, think about it. We go out and we beat our brains in finding a deal, renovating a deal, fixing up a property, owning the property, taking out a traditional mortgage, all to make $300 a month or something. I'm making $300 and $400 a month. I don't even own it. I'm loving it, right? So I know, Wendy Patton was probably one of my great teachers on that. on the lease option thing. But good stuff thing to do. If the township calls because the weeds are too high, it really falls back on the seller, right? It doesn't even fall back on me. So there's a lot of neat advantages to these sandwich lease options. I'm sure if you Google sandwich lease option, it'll pop up, or you can probably find it in some of the BiggerPockets forums or the books as well. So that's kind of it for lease options. What else did I like about finding properties without banks or money? This guy is all over the place. That is me. I do have ADD. I am all over the place. But so some of the other ways, I'd find these motivated sellers. I think I covered bird dogs a little bit, direct mail, MLS, for sale or for rent ads. But some of the other things I liked about trying to buy property without banks or money was obviously through making multiple offers. And one of the ways I would do that is requesting owner financing. So a lot of times I would request owner financing or even a seller second, that type of thing. But with owner financing, I don't need a bank, right? And my fees are dramatically lower. I have a really good buddy locally. I'm in the Philadelphia area, and he does a lot of that. He actually has many of these owner financed houses. And they're typically a senior citizen. Sometimes it's a widow or widower, and they're looking to get out and they need a return on their money. They were going to sell their house and they can't exactly put their money in a CD and make a decent return. And he has a really good track record and reputation in his community for doing this. And he would actually go and buy these properties and they would give him owner financing. It's a great strategy to take over a property, pay them a nice return, and avoid all the bank fees. So it's a pretty neat strategy. The other way sometimes is, even if you do have a seller second, if the seller is willing to hold a second mortgage, that could eliminate the need for you to put any of your own capital into the deal, even if you came to the table with traditional financing. So now chapter 6 and 7 of the book, Real Estate Note Investing. This is where I do talk about lease options and also talk about subject 2. I go over some deals about subject 2. I know at my company, PPR, we probably have purchased hundreds of property subject to the first mortgage because, especially in the beginning of my company, we specialized in junior liens. So many times we took over properties subject to the first mortgage. But you can also do that in your hunt for finding motivated sellers. A lot of times you can take over the mortgage that they currently have on their property. And there's a lot of neat advantages to doing this, right? With subject to, you'll get the deed, you'll have them deeded over to you. And what's kind of neat about that is you're taking over their mortgage, you're making their payments. You'll get the same tax advantages as if you owned it, even though the loan's not in your name because you own the property. You have no loan costs. You also have no personal liability. You don't have to qualify for the loan. So you can see that there's a lot of really neat qualities there. And oftentimes you can get a good interest rate too, or pick up some equity. So a lot of advantages to going to subject to. Nikki, you said for owner financing, you typically need a big down payment unless they agree to nothing or little. Could be, or sometimes you could get a real low rate. There's a lot of neat things you can do for owner financing. Sometimes you can get owner financing just for cleaning up the property and bringing it up to code. So where a seller doesn't have the money, they have a lot of deferred maintenance sometimes. So sometimes the fix-up could act as your down payment. So there's a lot of neat ways to structure that. Somebody asked, what's the checkout code for the discount on the book? 20% off if you use live note investing. Live note investing, all one word. If you go to biggerpockets.com/note investing. Give me some thumbs up if you like what you're hearing, guys. By all means, ask some questions, throw in some comments. If you really like the book, write me a review. I need all the reviews I can get. A lot of good stuff, guys. I'm glad everybody's chiming in and finds this interesting about being able to buy properties without banks or money. The So we talked about a lot of things: owner financing. We talked about lease options. Really, lease options are definitely one of my favorites because you don't need a lot of money. I had one bird dog I used to work with. I would watch him tie up properties with $10 and $100. He would tie up deals. So you don't need a lot of money to do lease options for sure. And the other thing, here's another thing I learned from Jack Miller back in the day was doing an option on a property versus taking the listing as a real estate agent to sell it. And it was like a big aha moment for me, right? I was like, good old Jack was, a lot of us were focusing on the commission. And I see how silly that was compared to, well, if I make 30 grand on the house and I'm making 2 grand on the commission, it doesn't take a rocket scientist to figure out which deal is better. But a lot of times just putting an option on the property with the seller and saying, hey, give me so much time to sell this place, and I'll pay you, $1,000 to lock up your house for the next, 6 months to give me to sell it at this price. And then I can go out and I can sell it for whatever. Pretty neat strategy, which could be a lot more profitable than the silly commission that I was used to trying to make, right? So that's a neat strategy that I had learned from good old Jack Miller. And of course, the other option is, all cash on a property. And it just doesn't have to be your cash, right? That's back to the private money and the hard money, like my buddy Pat Heller on the call today. So the great way to act like you have a lot of cash. You're going to pay cash for the property. Obviously, you need to get good price, good terms to do that, close quick, that type of thing. But if you're doing that, obviously you're going to lowball. What's the old saying? If your offer is not totally ridiculous, it's too high, right? So but really it comes back to this theory of having multiple offers. Usually I'm using note strategies to do that. And just so you know, I don't really look at real estate and note investing as separate. I look at it as real estate investing. I just use notes every which way, just like I use real estate strategies every which way. I hear people talking sometimes, they kind of separate them like they're two separate things. Well, they can be if you want them to be, but in reality, to me, it's all investing with real estate backed assets, right? So, however I do that, it's however I do that, right? There's a million ways to do that, right? So, but I do believe in making multiple offers on the same properties, and I utilize some note strategies in there to pull that off. I utilize owner financing subject to all lease options, and it depends on the scenario, right? Excuse me. So not every tool fits every job, right? So for example, I'm not going to put a lot of money into a property if I don't have the deed, for example, right? So if I get a subject to deal, now I have the deed, so maybe I will do something. But like a lease option, I would never put a lot of cash into a lease option, right? Because I don't have the deed. I don't own the property yet. So you got to be careful how you structure some of these deals and that you're using the right tool in the right place. So, hey, Jim, driving for dollars. I find vacant houses. I look up the owner in public records, finds the note holder, buys a discounted non-performing note. Is that a valid strategy? Yes and no. It's not as easy to pull that off. You do have better luck if the note owner is like an unknown LLC, like my company. So if like a PPR LLC owns the mortgage on that property, you have better odds of getting through to somebody. But if it's one of the major banks, you're going to have a tough time buying a distressed mortgage from them. It's just like trying to buy one from loss mitigation. It's very difficult because that's not where they normally sell their distressed notes. Their distressed notes are typically sold through a trade desk. Who else do we have? Ray, what's up, Ray? Let me see, who else we got? Anybody else have a question in line with what we're talking about? Here we go. Anthony, if you were 23, oh boy, that was a good question. It went away on me here. If I was 23, what would I do over? I'm gonna get into that at the end. That's my recap a little bit. Who else? Anybody else have a question? Hopefully you guys are enjoying the book, Real Estate Note Investing. Like I said, if you go to biggerpockets.com/note investing, plug in the code live note investing. Live note investing is the code, 20% off. Give me a thumbs up, guys. Feel free to write me a review if you like what you're reading. So yeah, if I was 23, what would I do again? It's a good question. I was actually talking to my youngest son about this. If I did real estate today, what would I do differently? Well, obviously I'd be smarter, hopefully, and would do things a little bit different. One of the things I did to find deals was I had bird dogs working for me. So bird dogs were wholesalers and I would be the bank. And the reason I liked that so much was they would do all the marketing and they would do all the running around. And I would just come in and fund the deal, and I would just cherry pick the best of the best, or I would finance their deals. Great strategy, great way to get deals. Now, if I was going to do some marketing and create a marketing team, sure, I would be doing the same things everybody else does. I'd be working down all the regular avenues, looking for the motivated sellers, the for sale, the for rent, the MLS, direct mail, other wholesalers, networking, all that stuff, trying to find deals. Everything from bandit signs to you name it, right? But the one thing I would probably do different, I would try to do most of my wholesales in my IRA account because I just don't like to pay taxes. But the other thing is I would also employ probably a different strategy than most people, because I try to get out of doing the heavy work, and I also try to get out of a lot of maintenance, and I try to get out of dealing with a lot of tenants. Now, how do you do that? Well, there's a couple ways, and I mentioned and kind of talked around it a little bit, but it would be, I have a really good buddy that does this in New Jersey. He specializes in good properties, right? Like the 200 to 250 range, which on the East Coast can actually buy a really good house. On the West Coast, I don't know. But the good part about that is he gets these good bread and butter properties, and he buys them where they are a value add. They need the work. They're a fix up. But he doesn't sell them right away. What he does is he sells them on a rent to own. And what's nice about that is every now and then one of them comes off his books, and then he adds another one to his portfolio. And he has a nice, manageable, he's out of the maintenance business. They've all been renovated, and all the tenants are potential buyers who are trying to buy on a rent to own. And he gets out of the maintenance business. He's out of the property management business pretty much. And he has a way more favorable tax structure that way. So, if I were to do it all over again, I think I would be doing a lot of marketing. If it was a property that needed a ton of work, I'd probably flip it out to another rehabber. I would be keeping all my subject to stuff. I'd probably be keeping all my lease option stuff. And then I would also maybe be keeping the cleaner flips as well and selling them on lease options. And I mean, that's just my strategy. I'm not saying I'm right about everything, but I do like the idea of trying to get out of that landlord trap, so to speak, because that's kind of what ends up hitting us pretty hard in the long run. It's hard to buy and hold properties long periods of time without ever having evictions and without ever having to deal with a lot of maintenance and tenants, and eventually rehabbing the properties again for a second and third time. So let me see. Here we go. Ray, what's the best strategy to close with a semi-motivated seller? She inherited her uncle's house and is a complete dump. She wants to sell it. However, she's worried she doesn't know. You want to deal with the decision maker. That I do know. So, Michael, any books I recommend on... I don't know what your question is. I might recommend on that. Probably one of the books I did read on buying houses with no money from or banks was through Conti and Finkel. Had a good series of books on that, and they would actually tell you what to say to motivated sellers. So I always liked their books. So no, a lot of great stuff today. We covered a lot of stuff. We talked about traditional financing. Sure, use it when you can, but there's no reason you need to have a lot of money, and there's no reason we have to involve a lot of banks There's no reason we have to take on a lot of risk with banks. We can actually move that risk. When you do a lease option, you don't have any risk. When you do owner financing, you don't have much risk. They're not reporting to credit, right? When you do a subject to deal, you really don't have any risk as far as credit risk or bank risk. So I don't know that that gets enough airtime. I don't know enough people buy into that yet. They think they have to have their own money. They think they have to use bank financing all the time. I'm living proof that you don't. I own many a property without any of my own money, without ever utilizing a bank. I have nothing against banks. I actually do a lot of business with them. So not a big deal there. So let me see if I have some more questions from you guys. Who else has a question? I know everybody's got it all figured out. They all know how to buy houses. Here you go, on wholesaling through your IRA. Is there books about that? Well, it's no different than wholesaling outside your IRA. What's kind of neat about that is, one time I bought a house for 40 grand. I sold it for 80 grand. It was all in my IRA. I didn't pay any tax. So, just because I'm a little bit older, some people feel like, they don't like doing a lot of deals in their IRA, but I find I can do a lot of things with my qualified plan, so to speak, and make a lot of tax-free money that way. I think a lot of people don't utilize their qualified plans enough, especially if they are a real estate investor. There's no reason to be getting caught up in that tax problem. And if you're in the flipping business, that's really what your biggest problem is. You have a huge partner that no one talks about, and it's Uncle Sam. Because Uncle Sam's taking 30% or whatever of every deal. And I'm not a big fan of that. I know if you can hold a property a year and a day, your tax drops literally in half on that. And I much rather do that. If you have to Airbnb it for a few months, or you have to, rent it, sell it on a rent to own, it can very well be worth it. Keep the newly rehab property in your portfolio. Sell a property that's older in your portfolio where most of the depreciation's gone anyway. I mean, there's some definitely solid strategies to think about, basically shuffling the deck of what's in your portfolio a little bit. So, okay, here we go. How does this due on sale clause affect these strategies? That's a great question. It doesn't. I mean, first of all, it gives them a right to call the loan. It doesn't mean they will. It's pretty rare. I mean, we've done hundreds, if not thousands, of deals that way. And I think one time we had a loan that was called, and it was because the borrower was deceased and they knew it. Now, the situation there, they still would have to foreclose, and it's not my credit. So I have, like in my state of Pennsylvania, it's a solid year to foreclose. So that gives me a solid year to figure something out, right? I can fix the property, rent the property, sell the property. There's a lot that can go on there. So now if I'm in Texas, it's a little different. Foreclosure might be much quicker, 60 or 90 days or something. Then it's a different story. So you got to know the laws in your state, and you got to know what you're doing. But due on sale clause has never really been a negative thing for me or a reason to not purchase a property. Now, if you're going to sink a lot of money into a subject to deal, you definitely want to know what you're doing, or have some kind of takeout financing available or access to capital in case that were an issue. So it's not for everybody. If you don't have that, or you don't have that ability to fix the property and flip it or something, then don't do that deal. But it doesn't mean you couldn't flip that deal to someone else who does have the wherewithal and the resources to pull it off, right? So what are thoughts about marketing absentee or out-of-state owners? The same thoughts I have about marketing to anybody else that's targeted. I think you just want to be consistent. I think you want to track your data, and you want to find out what works for you. Personally, I'm not saying I never bought a property from somebody that was out of state. I have, but I don't know that I actually bought lists or tried to market to them for that. All right, Ty, how do you run the numbers on my property? Well, you're asking a lot there. There's a lot of different ways you run the numbers on your property. It would depend on how much work it needs or what I'm looking for cash flow wise. I mean, today I'm probably, I'm hoping to get 400 a month cash flow after I'm all done, after PITIs, usually kind of my number, but everybody's different on that. If I was in an area where it's an appreciating area, I'm not as concerned about cash flow, so my numbers might be different. I might be looking more for some quick appreciation to access the equity to pull out and invest somewhere else. So there's all different strategies depending where you're at. So it's kind of hard to give you a one-size-fits-all answer on the numbers on my properties. It also depends whether the property is a total rehab or not, or whether it's just a quick clean out. Some stuff's just paint and carpet, some stuff's a major rehab. So obviously my numbers are different. I'm never usually buying a real distressed property. I'm all in at 65%, or I don't do the deal. And by that I mean acquisition, fix up, closing, that type of stuff. But I have some ability to cut back on some costs because I have access to certain things that not everybody else does, and it makes me more competitive, right? So some of that also comes into play, right? So what else do we got? Here we go. Do I do diligence? Get stuck. How do you do diligence? Make sure you don't. Well, you could do a title, William, to make sure you don't have any judgments or liens. It's a good idea if you're going to take over a property to at least do a current owner search in a lot of cases to see what you're walking into. But on a lease option, it's not going to be an issue. It depends on what type of deal it is, that type of thing. So, but, I know for my money, like one of the things I try to do, especially in the later part of my life when I was doing a lot of real estate investing and buying a lot of properties, was I was trying to not use my money. I was trying to use OPM for all my deals, whether it was acquisition, fix up, lease options, subject to owner financing, those types of strategies. And I used my money for notes and private and hard money deals that I was doing for other investors. And I'm able to grow my wealth exponentially by doing that. And it was a great strategy for me. So I was always working my equity. I was always working my qualified plans. So let me see. Somebody asked, can I repeat my cash flow numbers again? Yeah, I like to see at least 400 a month positive on some of my bread and butter rentals. I might go a little lower if I'm in a better area or an area that appreciates. I'm west of Philadelphia. I'm in a pretty, I invest in 2 different counties, and the one county's a little lower end than the other county. But so let me see. I'm guessing your book revisits all the topics you touched on today. Yeah, actually it does cover quite a few. Real estate note investing. If you go to BiggerPockets.com/note investing, by all means, guys, get 20% off. Punch in the code live note investing for 20% off. It's all one word, live note investing. Give me some thumbs up if you like the book. I guess the biggest compliment is a review. And I look forward to seeing you guys also again next Wednesday, same time, same channel. And appreciate everybody jumping on today. Hopefully this was helpful for you. Hopefully you can get out there and buy a bunch of properties with none of the bank's money or no money and without banks. It's been a great strategy for me. It's been a great wealth builder for me. I'm able to keep my money invested in other great vehicles while I'm using OPM to basically build my wealth. And it's been a great strategy for me and kind of keeps me out of that landlord trap too. As I get older, I'm more and more concerned with, how do I manage, less stress in my life, right? How do I keep managing tenants to a minimum, doing maintenance to a minimum, that type of thing. So I have a completely different outlook today, and if I were to do it all over, I'd probably employ a lot more of these types of strategies where, I'm buying properties without the banks or the bank's money, and it's a great way to do things. I love the lease option type strategies where I'm out of the maintenance business, I'm out of the management business. I don't have to pay a lot of real estate commissions. I don't have to pay a lot of bank fees. I don't have to pay a lot of taxes. You see where I'm going, guys. So wish you guys all a lot of luck. If you get a chance, pick up the copy of the book, Real Estate Note Investing. Hope you enjoy it. And thanks again for being on the call today, guys. We'll see you next Wednesday. Take care.